This is the reason for that software fear that we talked about in the last slide. The amount of capex that is going on in the AI space is just phenomenal. The total capex announced for 2026 for 1 year alone by the top 4 AI hyperscalers, as they are called, is 650 billion just in 2026. To give you a reference, the entire market cap of Reliance Industries in India is about 215 billion. So these 4 companies alone are spending 3 times the value of RIL in just 1 year on AI. So you can imagine the amount of innovation, the amount of new technologies that will be developed with this kind of investment that is going on in the AI space. And that is the fear that people have, that software companies may be totally wiped out if this is truly successful. Now, here's the paradox. Both the sectors are getting hit. The companies that are spending on AI are taking a hit, and the companies that are supposed to get hurt from that spending and perish, the software company, they are also getting hit. Now, both of them cannot be true at the same time, because what the market is saying is that spending will not generate returns. So if the spending will not generate return, then the spending will not happen. In that case, the software company should be fine. Or you agree that the spending will generate returns, will be very good, and the software companies will not be fine. Right now, the market is like thinking in 2 diagonally opposite theories right now, and pricing in that both of them will be true. Now, logically, that is not possible. Either the software companies will perish and the ROI on the investments made by AI companies will be very good, or the ROI won't be there and the software companies will not be hurt as much. So I think there is a push and pull between that. But right now, markets are so brittle. Brittle is the right word, that they are selling everything, even though both of them cannot be true at the same time. So then we decided, okay, let's look at the data. The market will do what it does. We have to invest based on what is the data available. So the first slide that we saw in terms of the amount of capex that these guys are doing, the 650 billion, this is the investment that is going on in the AI hyperscaler space. Now, this investment has to generate returns. And so when we are talking about returns, you need revenues from this investment, right? That revenues will decide what is the return that you are receiving on this investment. And so what is that revenue looking like? So this slide tells us what is that revenue looking like. As you can see, throughout 2025, you are seeing an exponential growth in the backlog of orders for these companies, for the same companies that are spending: Oracle, Microsoft, Alphabet, and Amazon. What is their revenue backlog from these services looking like? And you can see it has hit 1.6 trillion in Q4 of 2025. So the reason these companies are spending is because they have this type of order book, and that order book is growing exponentially in terms of future remaining performance obligations. So these remaining performance obligations are huge, and these are spread over 2 to 3 years. And that is why the companies are spending. So now we should see where these remaining performance obligations are coming from. So this is the revenue that is supposed to be generated by the hyperscalers. Where is this revenue coming from? Who is giving these revenues to the hyperscalers is what we want to check. Because if these revenues do materialize, or these orders do actually come in and they are getting paid on these orders, then the ROI is not a problem. The ROI on the capex, the $650 billion capex that we saw, is not a problem. And in that case, these companies will bounce back like crazy because the ROI is there if these orders do sustain at this rate. So here's the split. Where is that revenue, the orders that you saw in the previous slide? Where are all those orders coming from? The orders are primarily coming from 2 categories. One is the infrastructure side and the other is the application side. On the right-hand side of your chart is the application side, and on the left-hand side is the infrastructure side. The orange bar charts are for 2025. The blue ones are for 24, and the last one, or the purple one, is for 23. You can see the sharp increase in spend by enterprise companies who are the revenue generators for the hyperscalers that we were talking about. Now, the spend is roughly 50-50. What they are doing is that they are spending in 2025, they spend about 19 billion on application related items and 18 billion on the LLM related expenses. So every enterprise, when they need to do some AI work, they need an underlying foundation model like Gemini or OpenAI or Claude, which is where the 650 billion capex was going. So these companies are supporting that capex by providing this revenue. That revenue in the foundation models, as you can see in 2025, was 12.5 billion. Right? So let's go into each category. We will discuss all the major categories of spend over here. One is the foundation model, the next is the horizontal AI, and last is departmental AI. These are the three main categories, the orange charts or the orange bars that we see, where enterprise companies spent money in 2025. So we'll go through each one of them and where is that directed. The foundation model spend. That's the largest part that we saw in this chart, about $12.5 billion. A large part of that $12.5 billion is going towards LLMs. And these LLMs are provided by Gemini, OpenAI, etc. And you can see OpenAI is the blue line. They have lost market share. Orange line is Claude and the purple line is Gemini. So Gemini and Claude, they have both gained market share versus OpenAI has lost market share compared to 2023. So that is where the spending is going in asking those LLMs to provide output. So they use APIs to generate the output, and that's where about $12.5 billion were spent by enterprises last year. So this is real money. This is not fuzzy money. This money has already been spent and it is growing at an exponential pace. I would not be surprised if this would be more than $25 billion on just LLM spent by enterprises in 2026. So almost double of 2025. So there is real spend that is going on and it is being spent on models like Gemini and Claude, whereas OpenAI has been losing some market share over there. The horizontal spend, we saw the foundation spend, which is more on the left-hand side of the first chart, which was at the infrastructure layer. Now, this is more spend into application. So within application, the biggest spend is coming from productivity shift that we are seeing in terms of co-pilots. So companies are not interested in investing randomly anywhere. They are investing or spending on specific applications. Excuse me. And these applications, primarily they are spending on co-pilots, which immediately improves the productivity of employees. So co-pilots like for creating presentations, for writing emails, for doing presentations, as well as for note-taking, all these co-pilots are being used extensively, and that's where a large part of spending was done in 2025. The next comes departmental AI spend. So this is another spend which we saw in the application layer, where a lot of spending was happening and exponentially. And a large part of that is going into coding. So product engineering is nothing but coding. So you can assume that any and every code that was written in the last 1 year in 2025 had an AI component attached to it. Either it was generated totally with AI or partially with AI or even corrected with AI. So that's the largest spend within the space. So you can assume that anybody that is in the space of providing coding services, they are pretty much going to have trouble because AI is the one that is taking over coding. And you can see $4.2 billion worth of money was spent on coding tools, AI coding tools in 2025. So that is where companies that are providing easy, cheap coding services, they are definitely out of business already in 25. We are not even waiting for 26 over there. That brings us to, last but not the least, is the Okay, so all of this is fine. So they are getting revenues, they're spending capex $650 billion. But what does it overall conclusion look like in terms of numbers? So this slide shows us the conclusion. If you see the EBIT margins of the Google Cloud business, when the entire AI mania started in 2023, their EBIT margins for that particular business was 2.6%. In the last quarter, September 2025, it was 23.7%. So that's almost a 20 percentage point jump. If Google was not generating revenues or returns on the investment that they're doing in AI, this EBIT margin would not grow so significantly. And that's why we are not worried about the margins as well as the return profile of this capex investments, in spite of the fact that the market is worried and there may be some truth to it, but we are not worried about the capex investments that these guys are doing. So we are focusing on the revenues that are generated, the returns that are generated. As long as we continue seeing that, we are not worried about these stocks at all. So I think those were the main items that I wanted to discuss on AI versus the capex and what the companies are doing to recover money from that capex. And so far the story looks very good. The market fears are, the reaction seems right now something of the sort of shoot first and ask questions later. But once the market gets back to its sanity, we will see the normalization of stock performances over the next few months. So we are not worried about the short-term impact that we are seeing in the stock performance of these sectors and markets. In fact, this provides a very good opportunity for people who have missed out investing in the past, as this could be a good entry point for investors who have missed out. And we strongly recommend that if you have missed out in the past, this would be a good time to either add or even start a new portfolio in global stocks.